Good evening, everyone. I'm Chloe Drew. I'm here to share how you can say yes to AI even in high-stakes decisions and highly regulated industries, such as lending, the one I'm working in. Quick intro about me, by the way. That picture is different from what you just saw because I just recently used AI to generate one. I prefer this one. So here we go. I'm a 3-time founder in the fintech space. I've been, my full-time job is head of venture studio at Ensemblex. I've been an AI advisor to banks and fintechs for across 10 different companies. Before Ensemblex, I was an operator at Mission Lane. It's one of the pioneers to use AI to expand financial inclusion for underbanked consumers. And before Mission Lane, I was working a low-tech job called investment banking. All right, goals for today, 3 simple goals. As a practitioner of AI, I really want to exchange field notes, not just sharing them one directionally. I really want to tell you what I've seen, what I've observed, but also hear from you guys what you have seen and do you see anything different. And secondly, if you're still curious about AI but haven't used it in your day job, I want to inspire you so that you can also say yes to AI going forward. And lastly, I want to make some friends. I'll touch on how we can build partnerships a little later. So, since we're talking about the highly regulated financial service industry, any guesses on what percentage of banks or financial institutions are using AI today? Any guesses?
100.
All right, we got 2 extremes. 2%. All right. So the reality is a little more optimistic. 64% of financial institutions actually use AI. So a lot of this is really in what I call lower stakes decisions. So fraud detections or summarizing a call transcript in a call center. These are lower stakes because no decisions are made based on the AI output, right? You're summarizing what the fraudsters did, and then that summary is sent for internal review. Or the call script is sent to an agent so that they're more efficient on the phone. But if you zoom in to when AI is actually used in decisioning, right, when a consumer is applying for their first mortgage to apply for their first home ownership, that percentage actually drops to 32%. So think about this, almost 10,000 banks and credit unions and lenders in the country, and only about 3,000 of them are taking advantage of AI today in high-stakes decisions. So what this means is they're not really fully embracing the technology or reaping the benefit, and these potential first-time homeowners may be denied a loan or maybe denied a car loan, and that would really hold people back. And why? I think the biggest reason here is this industry is so highly regulated and people are rightfully or wrongly a little nervous to use such an advanced technology in decisioning. So just to list some of the regulations I have to deal with on a daily basis, you need to comply with Reg E, Reg Z, FCRA, ECOA, SCRA. I can go on, you get the idea. But still, I believe there is a way to say yes to use AI, even in high-stakes situations. And I've been doing that for many, many years, so have my partners at Ensemblex. And we have helped many banks and fintechs to take that leap. So here today, I want to share some field notes with you, again, to inspire conversations and maybe inspire some new users here. So first field note, very simple, use common sense. Firstly, if there's an apple, don't reach for the orange first. What I mean is, if you want to predict someone's favorite dessert, don't start by looking at their favorite jeans brand, right? Look at what they ordered previously for their dessert. Look at their Whole Food receipts, etc. This phenomena exists today in lending, whereas some lenders, especially fintechs, they would say FICO is crap. I would just look past FICO and use only alternative data. That's just reaching for the orange while you have a really good apple in front of you. So use common sense.
So what's the alternative to FICO?
So there's a lot of alternative data, such as trade line data, that's traditionally not included or factored into the FICO score, or cash flow data, or text data, which I'll touch on later. Next is use modeling technique if common sense prevails. For example, if someone has defaulted on every single loan they have taken out in the past, this person is way more likely to default on the next loan versus someone who has never defaulted on any loan in the past, right? So the likelihood just goes up based on the past trend. And it's just inconceivable if this trend would reverse, meaning if someone has defaulted on 100 loans before and magically somehow their likelihood of default will go down over time. That's unlikely. So if that's the common sense, just put that constraint in your model. And lastly, if you can't explain a feature in English, be very careful using it. That's because in lending, we have this fun job of explaining no's, every single no, to the regulator that's required by ECOA. And once I saw this model output from a data scientist, one of his top 5 features to predict someone's likelihood of default goes like this. The second derivative of a major purchase before a major holiday. So try explain to a consumer why they're denied a loan because of this reason, or also try to explain to the regulator why. Right, so good luck with that. Next, speaking of, know the regulations. Again, there's an alphabet soup of regulations. They're there for a reason. If you operate in this industry, know them well. And better yet, try to work with the regulators. There has been successful examples in my industry. For example, Upstart, it's now a public fintech, publicly traded. They use AI also in their lending decisions. And in 2017, they got this no decision letter from the CFPB. What it means is it's basically a get out of jail free card, so that Upstart could use really interesting alternative data in their loan decisioning without any red flags or fines or even worse from the CFPB. Right? So if you do communicate and work with the regulators, you could actually open up new possibilities and be truly industry leading. Next, less is more. So the complexity syndrome really shows up everywhere you look in AI. And I think this is one reason why AI has a bad rep, especially among regulated industries such as lending. So on the technical side, it goes kind of like this. You probably have heard from a data scientist, hey, my model is amazing because it has 1,000 features. That may be true in some other industries, but 1,000 features in lending usually means it's overfitted, right? So the implications are real. If it's overfitted, you probably need to update your model every 3-4 months. That's a big operational lift for the data scientist. And also remember ECOA, so you have to update all of your deny reasons every quarter. And then all of your operations team have to swarm, and your technical team have to recode all the reject reasons. So it's not stable from a model performance perspective. It's not scalable from an operational perspective, and it just leaves so much room for compliance gaps. So in fact, we actually worked with an auto lender here in the States. We cut their features by 90%. And the model performance actually was equally robust with only 10% of features left. And the complexity syndrome also shows up among business users. So if you work in lending, you probably have worked on rule version 78 in your decisioning. It usually happens like this. As a lender, when you start, you have some simple rules and say, okay, rules-based, we'll just deny and say yes in these situations. And then you launch your product. And 3 months later, a fraud attack happens, and then you add some more rules. And then another 3 months passes, a first payment default happens, and you overlay some more rules. So over time, the rules get so convoluted, the data inside is actually trapped, and the true predictive power of the data is not showing through. So what we also did for a different lender is we actually peeled back their rules. It may sound scary, but by really applying AI gracefully, we were able to improve the predictive power of their model, staying compliant, and making their life way easier. Lastly, probably the most non-obvious, organize your data. So everyone here wants to activate AI, use AI, and you probably have bought a few AI tools. But if you're dealing with AI day to day, you'll know that the data is still messy. A New York Times study found that a data scientist actually spent at least half of their day job just cleaning data, not even building model. And that percentage can go up to 80% across some organizations. So imagine this, if you have magically organized data, you can adopt AI 5 times faster. Wouldn't that be awesome? And I believe it was so awesome, I actually launched a company last year called Gestalt. It's here to really programmatically automate data so that lenders can truly adopt AI instantly instead of waiting for quarters or even years on their data team to finish the job. Gestalt is now live in the market. We have many happy lenders across mortgage, auto lending, personal lending, you name it. If you're curious, talk to me afterwards about Gestalt. So that comes to the end of my presentation. I'd love to make some friends. Thank you. Yes, I believe everyone can say yes to AI, even in a highly regulated industry like lending. So if you are still a little nervous and you're new to AI, I'd love to help you take that leap compliantly. On the other hand, if you're already an innovation leader and you're swimming in AI, and you're already thinking about alternative data, cash flow data, text-based data, and how they can be applied in lending in high-stakes decisions to even better advance your business agenda and serve more consumers and getting more people into their dream homes, I'd love to talk to you too. Some of the projects I'm really curious about is using cash flow underwriting for the credit invisibles and also using text-based data to provide additional lift to the predictive power. So if you're working in these fields, come talk to me later. Thank you. Do we take